Hi students, welcome to the video on financial accounting. In this video, we will discuss methods of valuation of goodwill and its need or importance. So first, in the previous video, we discussed what is goodwill. Goodwill is the reputation of any business concern. When the old partners are running the partnership business successfully for a number of years, they want the value of that goodwill or reputation, and they want to get a share of goodwill from the new partner who is admitted in the partnership firm. The new partner, after admission to the partnership firm, will get interest in the assets of the business and also the future profits of the business. So in order to get the future profit of business, he is to bring a share of goodwill to the business. Then how much he will bring to the business, or what will be the value of his share of goodwill, that we will discuss in this video. First, what is the necessity or requirement of bringing goodwill or share of premium or goodwill to the business by the new partner? First, when profit sharing ratio is changed, because when the new partner is admitted into the partnership firm, definitely he will get a share of the profit. As a result, the profit sharing ratio or profit share of existing partner, old partner, will be reduced. Second, when a partner retires or dies, when a partner retires, he wants to take his share of goodwill and capital from the business. Then similarly, when a partner dies, his legal heirs, they also want his share of goodwill and capital also. Then when two new firms are amalgamated, when XY firm is amalgamated with AB firm, then the two firms have to revalue the goodwill. Then when a firm business is dissolved or sold to a company. So these are the requirements for which the partnership firm wants valuation of goodwill. So goodwill may be valued based on three methods. One is average profit method. That means suppose goodwill will be given at some number of 2 or 3 times or 5 times of average profit of the business. Average profit means suppose the past 3 year profit is given, that will be adjusted and average will be calculated. Based on that average, suppose 3 years average profit, 3 will be multiplied, that will be the value of goodwill, and the new partner, suppose he is getting 1/6 share for on value of goodwill, he will also bring 1/6 share to the partnership business. Then second form is super profit method. Under super profit method, the business has to calculate what is the normal profit of the business on investment of a new partner. Suppose the new partner has brought 1 lakh to the business. So 20% suppose the rate of return. If he could have invested in other business, similar business, he could get 20,000. But suppose the average profit is 50,000. So difference is 50,000 minus 20,000, 30,000 is the super profit. Suppose his goodwill will be valued at 5 years super profit, then 5 will be multiplied and his share of goodwill is calculated 1/6 of that value. Third method is capitalization method. Under this capitalization method, value of net asset will be calculated. So formula is average or adjusted profit for so many years divided by normal rate of return. Then value of net asset will be calculated. From value of net asset, whatever the net asset of the existing business, that is the capital, that is assets minus liability, will be deducted. Difference is the value of goodwill. On that, he will bring, a new partner will bring his share, that is 1/6 of value of goodwill. Then we will solve our problem. From that problem, we can calculate the value of goodwill based on three methods and its accounting treatment. First is A and B are partners in a firm sharing profits and losses equally. On 31st March 2023, the balances of their capital accounts were 3 lakh, 2 lakh. The average profit of the firm is 1,36,000. Rate of normal profit is 20%. On 1st April 2023, they agreed to admit C as a partner for 1/4 share. She will bring 1 lakh as capital. So you are required to compute the value of goodwill of the firm on admission of C. If goodwill is to be calculated on the basis of first 3 year purchase of average profit. So we have to know average profit method. So average profits, it is clearly given 1,36,000. Goodwill is 3 years average profit. So value of goodwill 3 years average profit is 1,36,000. Goodwill is equal to 3 years average profit. 3 into 1,36,000. This is 000 4,08,000. So his share of goodwill, his share of goodwill will be 1/4. His share of goodwill will be 1/4 of this. That is 1/4 into 4,08,000. That is he will bring 1,02,000 to the business as his share of goodwill based on first method. Then based on super profit method. Super profit method. So we have to calculate the super profit. Super profit is average profit, that is 1,36,000 minus normal profit. Normal profit means the investment is here 3 lakh plus 2 lakh capital 5 lakh and it is 20%. So 20% of 5 lakh. So 20% of 5 lakh means it is 1 lakh. So 36,000. Goodwill is 5 year super profit. So 36,000 into 5. 36,000 into 5 if we value under super profit. 1,80,000. So his share of goodwill will be share of goodwill 1/4. His share of goodwill will be 1/4 of this. That is 1,80,000 into 1/4. So that is 45,000. Then goodwill will be valued at capitalized value method. Under capitalized value method, the formula is average profit capitalized or capitalization method. Goodwill is equal to, first we have to calculate the net asset. Net asset is average adjusted profits divided by normal rate of return. Here average profit divided by normal rate of return, that is 20%. So 1,36,000 by 20% is equal to 6,80,000 less net asset available in the business, that is capital 5 lakh. So value of goodwill is 1,80,000. 1,80,000. So his share of goodwill based on capitalized methods will be, his share of goodwill is equal to 1/4 of 1,80,000. So it is 45,000. Suppose for accounting treatment, we will take into consideration 3 years purchase of average profit. So for 3 years purchase of average profit, the new partner has to bring 1,02,000 based on first method. So his share of goodwill 1,02,000. So various methods we are considering only on adjusted profit or average profit method. Under this method we will do accounting treatment. Accounting treatment. First condition is goodwill is brought by new partner privately. First privately. Goodwill brought privately. That is outside the purview of business. Goodwill brought privately, no journal entry. It is separately, it is debt. So no entry for this. It is outside the purview of business. Second, goodwill received in cash or check. Goodwill received in cash or check. So then generally the amounts is received in check, so bank account debited and to either we can credit goodwill or to seize capital account, then goodwill brought in by C credited with capital, then the amount will be adjusted, so seize capital account debited, it will be taken by the old partner in their sacrificing ratio. In this case there is no change in the profit, existing profit, that is they are equal partner, so they will take 1,02,000 equally. So seize capital account debited 1,02,000 to yes capital account, that is 51,000, and B's capital account 51,000. Then third condition 51,000. Third condition, goodwill withdrawn by goodwill not brought in by new partner, not brought in by new partner. When the goodwill is not brought in by new partner, so entry is new partner's capital account will be debited, so C's capital account debited to A's capital account to B's capital account to B's capital account. It is 51,000, 1,02,000. Then it is distributed equally between the two partners because they are equal partners. Then this is the condition. Then fourth condition, when there is goodwill existing in the business. Suppose goodwill is already existing in business, that will be written off among the old partners. So goodwill existing in the business. Existing in the business. Journal entry is goodwill existing in the business. So partner's capital account is debited, A's capital account debited, B's capital account debited to goodwill account, being goodwill written off. Suppose the value of goodwill was in the assets of the existing firm was 1 lakh, it will be debited equally, that is 50,000, then goodwill written off. Then suppose he is not bringing in share of goodwill, so C's capital account will debited, his share of goodwill is 1 lakh, so C's capital account debited 1 lakh to A's capital account to B's capital account, that is they are equal partner, so amount is 51,000 each to B's capital account. Thank you for watching this video. In the next video we will discuss some more important problems.